Today, we're kicking off a 3-part series all about financing. In this video, we'll be diving into the basic terms that you're going to need to know about the financing world for your real estate exam. So if you're studying for your exam, grab your notepads and let's dive into the wonderful world of real estate financing. All right, let's begin with discount points, or as we like to call them, points. You may have heard this term tossed around, but what exactly are points? Well, think of points as upfront interest payments. Typically, 1 point costs 1% of the total loan amount and will lower the interest rate on said mortgage. But don't be fooled. This does not mean the interest rate is lowered an entire percentage point. Usually it's anywhere from 1/8% to 1/4%. Let me break it down with an example of something you may see on your real estate exam, since this is a concept I get a lot of questions about, and you can see just how easy it really is. Jody received a home loan for $340,000. She wants to lower her interest rate and will pay 2 points at closing. How much will Jody have to pay in points at closing? Feel free to pause the video now if you'd like to work this question on your own. Okay, remember, 1 point costs or equals 1% of the total loan amount. So if we have 2 points, then that means 2% of the total loan amount. I'm going to let you in on a little secret here in a little bit. We see the loan amount in this problem is $340,000, and we see that Jody will pay 2 points. So we have to take 2% of the loan amount to find how much Jody paid in points at closing. Here's that little secret I told you I'd let you in on. The word of, like we see here, just means to multiply in math language. So as you can see, all we have to do is multiply the loan amount by 2% or 2 points. Of course, we can also use the T chart, where we'll just place the loan amount in the total column here and the 2% in the rate column over here. Then we convert the 2% into a decimal by dividing by 100, and you get 0.02. And as we already knew, we just have to multiply 340,000 times 0.02, and we get $6,800. So 2 points based on a $340,000 loan makes the answer to this question A, $6,800. If you want more information about discount points and the other mortgage loan fees that you may see on your exam, check out the link to my video in the description box below labeled mortgage loan fees. All right, now that we've got that concept down, let's dive into our next concept. Let's talk LTV, or loan to value ratio. Sounds fancy, right? But it's pretty straightforward. LTV is a ratio that shows how much you're borrowing compared to the total value of the property or sales price. When it comes to memorizing this formula for your exam, this one is a breeze, since the formula for loan to value ratio is literally stated right in its name. Since ratios can be expressed as fractions, think of it as the loan divided by the market value or sales price of the property. But remember, doing this on a calculator, you will get your answer in a decimal once you divide. And we need a percent. So this is where they'll get you on the exam. So all you have to do is just remember to convert it into a percent. And we do that by just multiplying by 100 or moving the decimal point 2 places to the right. For example, if you're buying a house worth $200,000 and taking out a $160,000 loan, your LTV is $160,000 divided by $200,000, which ends up being 80%, which also means you have a down payment of 20%. Let me know in the comments if you know exactly how I got to that 20% down payment amount. Now, why is this so important? Well, lenders use LTV to assess risk. A lower LTV, meaning a larger down payment, often means lowering risk for the lender. Understanding LTV also helps you know how much equity you may have in your property and can also affect your interest rate and mortgage options. Check out my video in the description box below if you need more information regarding loan to value ratio. Let's talk about something the lenders will require if you're putting down less than 20%. If you guessed PMI, then you are correct. PMI, or private mortgage insurance, is like a conventional loans bodyguard. Let's see why. If your down payment is less than 20%, lenders will ask you to get PMI. This insurance protects the lender in case the borrower can't make the payments. It's an additional cost, but it can make buying a home more accessible with a smaller down payment. It's important to note that PMI is not for the life of the loan. It's a temporary charge. And once your equity reaches 20%, you can often say bye-bye to PMI. While conventional loans have PMI, FHA loans have what is called Mortgage Insurance Premium, or MIP. It's an upfront premium and is charged at closing plus an annual amount that is prorated and paid monthly, just like PMI. Understanding when and how to get rid of PMI can save you money over time. Here's a fun fact about me. In 2021, I was hired to conduct a lot of BPOs, or broker price opinions, on homes as their value had increased significantly and people were trying to remove their PMI payments even though they had literally just purchased their home as early as 2 years ago. Since the market had increased property values so much, people were contacting their lenders asking to remove the PMI charge. Talk about saving money. Anyway, let's jump into another charge where if you play it right, you can potentially save yourself some major money in the long run. The big I word, interest. It's like the rent you pay to borrow money. Let's talk about it. Interest is the cost of borrowing money. If you borrow $100,000 at 5% interest, you're paying $5,000 a year just for the privilege of using that money. How did I get that? Easy. I just used the simple interest formula. I equals P times R times T, where I is the interest amount, P is the principal amount or starting balance, R is the interest rate or percentage, and T is time based in years. Let's check it out here. So if I borrowed $100,000, that would be my principal balance, and the 5% is the rate. Convert the 5% into a decimal by dividing by 100, so that's going to equal 0.05. They say only 1 year, so $100,000 times 0.05 times 1 is going to equal $5,000 in interest for the year. Understanding how interest works helps you compare loan offers and plan your long-term financial journey. The lower the interest rate, the less you'll pay over the life of your loan. Need more help on this concept? Check out my real estate ebook where I explain this entire thing and more, and even provide you with over 100 math practice questions similar to the ones that you may see on your exam. It's our #1 seller and has definitely helped hundreds of students boost their score on the real estate exam. I'll drop a link to this ebook down below in the description box. PITI. Sounds like a catchy acronym, right? It's the secret sauce of your mortgage payment. PITI breaks down your monthly mortgage payment into 4 parts. Principal, the amount you borrowed. Interest, we just talked about that. Taxes, which are your property taxes. And insurance, or your homeowner's insurance. It's like the all-in-one package deal. Now, the principal and the interest are determined based on the interest rate and the loan terms, like whether it's a 15, 20, or 30-year loan. It's determined using a payment factor chart like this. Notice how it says per $1,000. Let's look at an example of something you may see on the exam. Bob and Susan purchased a home for $125,000 with an 80% LTV ratio. If they choose to get a loan for 20 years at 7.5%, what is their monthly principal and interest payment? Okay, so here we first have to find the loan amount. Remember, when it comes to the buyer, we always take from the loan amount, just like we did with points in our first example. Now, let's take out the T-chart. Place the purchase price of $125,000 in the total column, then the 80% in the rate column. Convert 80% into a decimal by dividing by 100, so that equals 0.8. Now we multiply. So $125,000 times 0.8 equals $100,000. Now that we have the loan amount of $100,000, let's take that $1,000 and divide it by the loan amount. So $100,000 divided by $1,000 equals $100. Now we just go to the table, find 7.5% at 20 years, and see the total there is 8.06. So all we have to do now is multiply 100 by $8.06, and we get a total of $806. That's going to be Bob and Susan's monthly principal and interest payment. See how easy that was? The one thing that gets people here every time is that they forget to divide that loan amount by 1,000. So just make sure you don't miss that little step when you're taking your exam. Now, the taxes are calculated by the yearly total. Usually, you would just divide the amount by 12 to get the monthly total and add it to the principal and interest amount. You could do the same with the homeowner's insurance amount. Together, those four equal your monthly PITI payment. Understanding PITI helps you budget effectively. It's not just about the loan, it's about the total cost of home ownership. Knowing what goes into your monthly payment keeps you financially savvy and allows you to help your clients understand what their monthly payment consists of. All right, buckle up because we're talking paperwork here. But don't worry, I'll keep it simple. When you get a mortgage loan, you sign some important documents. The mortgage is like the roadmap for the loan, and the promissory note is your promise to repay. It's the legal side of homeownership and a document that's between the lender and the borrower. Think of it like a legal IOU that says the borrower agrees to repay the loan amount based on the terms of the loan. The promissory note is issued by the lender and signed by the borrower. It is considered a contract, and signing it legally obligates the borrower to pay back the amount borrowed, plus any interest, as defined by the promissory note. Understanding these documents ensures you know what you're getting yourself into. Mortgages and promissory notes outline the terms, conditions, and responsibilities. It's your guide to a smooth and successful homeownership journey. Now that we discussed promissory notes, we'll be bringing you another video all about the different types of mortgage loans that we see as real estate agents. If you found this video helpful, give us a thumbs up and don't forget to subscribe for more real estate wisdom. Stay tuned for part 2 where we dive even deeper into the world of real estate financing. Until next time, happy learning.